Hello, hello. Fantastic. Hello, everyone. My name is Emeka Ajene. As mentioned, I'm the publisher of Afridigest, which is a business media platform focused on Africa's innovation economy. I'm very excited about this panel. We have some heavy hitters here. You know, the last panel, Fireside Chat, was fantastic, realistic discussion around failure. And one of the reasons startups fail is actually an inability to navigate the regulatory landscape. So we want to, during this next 60 minutes, explore the interplay between regulations and innovation. And we have a group of folks with diverse perspectives to kind of shed some light. So as mentioned, Akin at the end, the Honourable Commissioner of Finance for Ekiti State, will be able to share with us some perspectives around innovation, regulations from the government side. Next to him, we have Ms. Yewande Adewusi, the CEO of Alitheia Capital, who could share with us how innovation can help and hinder, or hinder, regulation could help or hinder innovation from the investor's lens. Next to him, we have Obi Emetarom, CEO and co-founder of Zone, which is a very interesting company. I'm interested to hear his story and kind of how he's navigating being an innovator in a new field while there's a breadth of regulatory change happening. And next in we have Mr. Dalu Ajene, the CEO of Standard Chartered Bank of Nigeria, who's actually could share with us what it means to stay regulatory compliant while leading a legacy institution. So really excited. I think we want the session to be dynamic. So please, as we talk through, generate questions, hold on to them, and at the end of the session, we'll come to you for your questions. So I think a fair place to start is actually with the government side. So I'll come to you first, Akin. And in addition to your role as Commissioner of Finance for the state government, you're also the chairman for all the finance commissioners in Nigeria. So I just wanted to understand from you, first of all, what's the role of a finance commissioner, and how do you and your colleagues think about the role of regulations in Nigeria's financial sector?
Thanks. I think, your first job is to keep your boss and yourself out of prison. So that's pretty much your first job. And then obviously, more importantly, is ensuring that resources are properly allocated for whatever the development objectives of the government of the day is. So it's not a place where you're liked very much. I always say the Commissioner of Finance in a state is like a chief compliance officer of sorts, because they're always on limited needs with, as you know, very limited resources. And so my job day to day is to ensure we don't make too many mistakes in spending our limited resources. We're allocating resources to the areas that best drive our development agenda. It's also getting on the governor's wrong side a lot, right? Because governors are very impatient sometimes to show, because the political cycle, as you know, in Nigeria has a 4-year examination period, right? So they're very quick to say within 2 years, we need to develop something that shows the people that we've done some work, right? And as you know, a lot of that spend in the places that really matter don't deliver value over that short term. So you've got to also keep the principals disciplined to recognize that, look, you must balance the optical benefits of, capital allocation with some of the longer term benefits. And the second part, I know it sounds funny, but it's very easy in today's Nigeria, to go to jail with the best of intentions, right? The procurement process in governance is very unwieldy. It's not aligned, in my opinion, to the kind of rapid development the country needs. But because we operate in a low trust environment, we have to work within the confines of what is available. So it might take you, for example, close to a year to complete the procurement process for a large-scale road, right? But that's what it is. So sometimes, even where the principals are a bit impatient, our job is to ensure they stay the course. We follow what is a somewhat unwieldy process to still achieve some of those objectives. So when I listen to startups and businesses speak about some of the regulatory red tape they experience, they speak to me like, I'm the enemy. So I can't really say to them that for everything you experience on your side, even within government, I'm also a victim of what is sometimes a cumbersome and complicated regulatory environment. I'll stop there. Thanks.
No, thank you for that. Really appreciate that. Another kind of, you spoke about startups viewing you as the enemy. Another kind of combative counterparty to startups is investors at times. So I just wanted to come to you, Yewande, and another thing that was mentioned. Well, first of all, I'll say Alitheia Capital. You guys have invested in various financial services, fintech firms, Paga, Baobab, Microfinance, and several others. And you've also invested in kind of companies that are not in as regulated sectors. So I just want to get from you just what do you see as the role of regulations when you're making investment decisions? Akin talked about capital allocation. So just what role does the regulatory landscape by sector play as you're thinking about allocating capital?
Thank you. It pays everything. Alitheia Capital is an impact investing investor, so we're always matching financial returns and social impact, and that social impact has to deal with us also being compliant. Whenever we're making an investment from the get-go, we're looking at what's the regulation around this business. What do they have to do to meet that compliance requirement? What are we going to invest to make sure they're also compliant? So we're constantly thinking about it from whatever sector. Like you said, we deal with tech, we're also in agribusiness, we're also in logistics and mobility. So you can imagine all the investment managers and the value creation team throughout the portfolio management process. We're thinking, what's happening in the regulatory environment? How is it going to impact this business? How is it going to impact returns? So it's a constant keeping on top of what's going on in the different regulators that touch the businesses that we invest in. A lot of work, and of course, regulation, there's a cost to compliance, and we always have to work with the portfolio companies to let them understand it's not a tomorrow thing. Sometimes they want to put it off, and we're like, it's not a tomorrow thing. The regulator is coming at you next week, and they're like, no, we can just put it off because we're trying to balance the cash that's available for day-to-day operations and meeting regulatory issues. So we're like, no, let's just make sure we're on top of our game on our regulatory compliance matters, wherever they may sit. And we will also make sure that it's documented at the beginning of our investment process what needs to be done to make sure this company succeeds and not impacted and value destroyed by not being compliant.
Thank you for that. So, Obi, I want to come to you next. One thing Akin mentioned is that, it's easy to go to jail despite having good intentions, right? So for you, I think you've been building financial solutions for about 20 years, right? Maybe over 20 years now. So I just want to get your, your opinion in terms of how do you navigate, a changing regulatory landscape, right? Especially with your background from Parkway to kind of zone, app zone, the carve out, et cetera, as Nigeria has kind of had, a lot of changes in the sector.
Okay, great question. Now, in our case, we sort of evolved from literally no need to be regulated and then increasingly more regulated, right? So when we started, we were just a technology provider to banks, which meant that we didn't need to be regulated by the central bank. It was more just a tech play. Then we became more like a shared infrastructure provider that needed to integrate into banking systems, and we needed to get a license, what is called a payment solution service provider license. And so that was one layer. And so we started to see the early levels of engagement with regulators and some of the constraints that come with it. More recently, we evolved to a whole new level of a more profound license. We became a licensed payment switch, and more so doing payment switching with a new type of technology, blockchain, which at the time we started was being frowned at by the regulators because of cryptocurrency, which is not regulated, right? Not compliant. And so it took us from not having to worry about regulators to being in a space where we are like literally under the spotlight of regulators and just navigating how to relate with them and still do what we need to do. And what we learned in summary is what regulators want, right? Regulators want to ensure that end users get maximum value for whatever the service is provided in the ecosystem, that the operators are efficient and can run seamlessly, and I think most importantly, that all this can happen with zero risk. And so what we learned is, if you can position in a way that provides regulators comfort that you're not threatening any of these needs they have, then it becomes much, much easier and more effective to engage. Four main characteristics I think we've learned about how to position in that regard is, one, no matter what, always be compliant, right? No matter what, like, be the good boy, be the guy that sits in front of the class, wants to answer questions, like make their work easier, right? So that's one thing. Be responsive, be open and transparent with communication. That's one. And then the other thing, which is surprisingly key, which many people don't know, is people think regulators don't like innovation, but it's not true. It actually makes them look good. And the reason why is, when there's a new innovation that is successful during a particular regime of a regulatory body, they usually will take ownership and credit for it. That, oh, during our time, this is how this industry improved. So being seen to be contributing towards that, innovating in that direction, is a very good thing. The third thing is the relational part, engaging, communicating. So regulators like you to interact because they want to have visibility into what's going on. They want to get information. And it's just that human relation thing that is just real. I think the last thing is a reputation for integrity. Because the way regulators think is it's about risk, right? So they're assessing who is a more risky candidate, who is not. So they tend to be more comfortable with, say, founders or leadership teams, CEOs or leadership teams who have a good reputation or don't have any questionable reputation. And it's easier to get things done, it's easier to influence, it's easier to engage. So yeah, these are things in summary in our sort of journey from zero regulation to almost maximum regulation.
No, that's fantastic, and I think we'll come back to some of that in a bit more detail. So I think so far we've heard from a founder's perspective, an investor's perspective, and a bit commissioner's perspective. I'll just say that. So I want to come and talk to Dalu. Obviously you run Standard Chartered Bank Nigeria. I think the bank generated something like close to 100 billion naira in gross earnings last year. So I'm just curious, and if you think about, the tech ecosystem, a lot of people, maybe warranted or unwarranted, think about regulations as a barrier to innovation. But there's another way you could look at it in terms of, it's creating opportunities, creating defensibility, et cetera. So just from, your perspective as the CEO of an incumbent traditional institution, just what's your view of regulations?
Hi. Okay. So I think broadly speaking, I think, my panelists have spoken a lot of, given different perspectives, but I kind of broke it down into three words came to mind. So integrity, confidence, and trust, right? And when you think about regulation and you think about those three words, and funny enough, it says ICT, but, we're in an environment where, we all interact in a system. Whether it's a bank dealing with individuals' savings and leveraging those savings to be able to deploy capital in a range of areas, the integrity of that system has to be sacrosanct. And I think it cuts across whether banking into, fintech, investing, etc. The concept of integrity is not just an individual integrity, but it's integrity of the system, integrity of stakeholders, and everybody that actually plays with information that's transparent and one can actually analyze, be able to assess, and be able to make informed decisions. So integrity is quite important. And I think integrity leads to confidence, and confidence leads to trust. And all of this has regulatory underpins that gives the guardrails as to what defines these three factors, right? So the way I look at regulation is that regulation provides guardrails that enhances the integrity components, the confidence components, and the trust factor. And when you go out of whack, then systems fall apart. And it's the function of the regulation to bring those systems back in order, right? So I was listening to Obi's comments around, transparent engagement with regulators. So transparent engagement with regulators is not just a function of, regulators trying to get into your business for the sake of it. I think regulators appreciate that change is ever constant, but it's important for them to be ahead of the change and be able to anticipate how that change impacts the integrity of a system, right? And so long as the change and components of that change doesn't threaten integrity of the system, then I think regulators generally are okay. But where it threatens the integrity of a system, then it's the onus of the regulator to actually think creatively as to how to put the appropriate guardrails to ensure systems don't fall out of whack, right? And I think that's a very important component, particularly when industries either scale or bettered or whatever. It's important to be able to get guardrails in place to ensure that the actors operate in sync to be able to enhance confidence and trust. So I think that, for me, is the function of regulation, whether it cuts into banking, whether it cuts into fintech, whether it cuts into technology. It's around a system and ensuring that that system has the components of, again, integrity, confidence, and trust to allow it to scale and blossom.
Oh, fantastic. So just, I guess, on that point, and Obi, I'll come to you, right? So Dalu talked about guardrails, among other things, and I'm curious to kind of dive deeper. So Zone is billed as Africa's first blockchain payments network, right? Certainly, I mean, I shouldn't say build, it's, reality, right? But so in that sense, you're pioneering, something new, something that affects a lot of lives, a lot of transactions, and you're doing so in an environment that hasn't historically been friendly to blockchain and crypto, right? So, to use kind of the language that we mentioned, kind of the right guardrails haven't necessarily been in place, and there have been a lot of changes in terms of, depending on, as Akin mentioned, some of the, who's in charge, right? So I just want to get your sense, from, in terms of war stories, right? Actually building and, rolling out core, separating core from your business, your banking as a service platform, and focusing on Zone. Just how, what are some of the obstacles to kind of staying regulatory compliant that you guys faced, over the years?
All right, cool. So the first thing was, so blockchain has been deployed as the main enabler for cryptocurrency, right? And everybody knows about that. And like I said, regulators, because cryptocurrency is not compliant, right? AML, KYC, and some of the other things. So regulators have become like really apprehensive all around the world. And so the first issue was you're trying to take this technology and implement for traditional like banking and payments. And so the first was that skepticism. And when we launched, or when we were running our pilots, it coincided with when a lot of crypto firms were being shut down by the central bank. And so the first thing we had to do was create the clear separation, right, between crypto as an application of blockchain and blockchain as a tool, as a technology, right, that enables efficiency. So that was the first thing. The other thing which is really, really critical, or became critical, is we needed to align what we were doing, even though it was different, with the existing regulation as much as possible, right? So sort of walk back, even at the expense of compromising some of the capabilities of the system, right? Just as an initial entry to be able to comply as much as possible with the existing regulations, because we realized that would be critical. And of course, we got advice from a lot of the banks. Right? The banks advised that, hey, look, even though this is different, here, and here, I would advise you sort of align this with what exists. And that helped. The third thing, obviously, was now a lot of education with the regulators, just showing clearly how this works, how it's different from crypto, how it enhances the industry, how it aligns as much as possible with the existing regulation. And yeah, so we had a lot of that engagement. And to everybody's surprise, around that time, rather than get shut down, we actually got an approval, what is called a letter of no objection to deploy this new technology into the industry. And that's when we realized that, look, regulators are actually excited about improving. They want to improve the system. And we showed clearly, again, one more thing, like problems, specific problems that you're solving that the regulator cares about. That's really critical. So if you're talking about things like reliability, for example, or helping to improve security, or helping to improve the customer experience, and so on. These are genuine issues that regulators, in the financial services industry, so the central bank particularly, where like they pick their imagination that, oh wow, this helps. These are issues we've been thinking about how to solve. And so for me, it was an interesting experience seeing that we could achieve the exact opposite of what everybody thought at that time. So that's for us. It's been a good ride. What we continue. So we've had subsequent engagements with the central bank to roll out subsequent features, and the common sort of denominator across board is just continue to carry along, continue to be transparent, continue to engage, continue to educate and explain, and so on and so forth. And we'll just keep doing that.
Thank you for that. I think that's very practical in terms of the advice for entrepreneurs in the audience here. And in terms of that practical advice, I want to come to you, Akin, I guess from the other side of that. If you think about regulations and I guess collaboration effectively. So the question for you is very simply, how could startups, founders, entrepreneurs collaborate effectively with government bodies when developing and influencing regulations and policy?
Look, I think Obi has sort of set the tone very well, and the conversation starts with trust, right? So we're in a fairly low trust environment. So businesses think regulators are either there to raise revenue or just increase red tape. But that's very far from the truth. If I sit down, whether it's the central bank, whether it's FIRS, whether it's SEC, a number of these regulatory agencies actually have a mandate to improve the lives of the people, right? So it's how do we improve these systems to ensure that there's the right level of trust. So if you start the conversation from a perspective of that no one knows the business better than the operator, right? So the regulator, unless in few cases where these are operators who are now, so if we, for example, say to Dalu, go and help us run the central bank, right? As a bank CEO, you then understand at least we expect that you have a decent knowledge of financial system stability, etc. But in many cases, these are people who don't have that much industry experience, right? So they lean on you, the entrepreneur, to actually help them understand what's happening in the environment. Where are the sands shifting? What do the tea leaves read? So if you say, I don't want to be a thought leader, then you do yourself a lot of disservice. Because when these guys are setting up these regulatory environments, they're speaking to businesses. They want to talk to businesses. They want to hear your opinion. They want to expose draft regulations to you. Whether it's a revised tax code, whether it's a code governing cryptocurrencies, for example, even in who governs that. I remember when the crypto conversation started in Nigeria, and just because I took an active interest in it, there was a lot of debate about where is that governed. Is that the central bank because are we treating it as a currency, or is that the SEC because we're treating it as an asset/investment, right? At the end of the day, when the SEC took over, that regulatory authority, they also wanted to engage with companies who participate in that space. Let's even understand what the risk profiles are. You know, from a tax perspective, FIRS wanted to get in the room to say, how do we tax some of these revs, right? What are the capital gains here? How do we extract that much value? Where the exchanges sit outside Nigeria, but the beneficial interest is in country, how do we ensure Nigeria doesn't lose revenues on that? Many of these guys were happy to say, hey, you know what, this is a sandbox, let's go in there. This is what we're trying to do. These are the systems we're trying to deploy. How does that affect PSSPs? I know some of the active PSSPs went in there and said, look, you know what, some of these things have, you know, data protection, regulatory impact. How do we also ensure that our investors don't get antsy, right? To say, look, yes, you are complying with regulation in Nigeria, but that compliance opens you up to all sorts of infractions globally. Now, no one has all the answers. So the less you engage, the more likely that the outcome will not be ultimately beneficial to everybody. Not to the startup, not to the regulator, not to the ecosystem, right? So I think for me, the first point is that engagement is necessary. Second point is, again, I think Obi makes the strongest point that every regulator wants to say, hey, during my time, you know, we advanced the ecosystem this far, right? So everyone wants to show that they're winners, you know, and so they'll always want to listen to people that can start the conversation by saying, my job here is not to fight with you. My job here is to make your job a lot easier. So, for example, in the states where I sit, the biggest problem I have is how do we collect revenues, right, from businesses and individuals? But we're not going to go after people with a stick, right? We're always willing to say, hey, you're a university, you run a business here, come tell us your pain points. You know, what's broken with our system? How can we make the tax code easier for you, right? Because we recognize that a rising tide lifts all boats. So from a government perspective, you know, you can't tax or regulate people who are not in existence. So you are joined at the hip because you need these businesses to run for you to even have any form of relevance in the industry. So I think summary is, look, thought leadership is very important. Sometimes it gets started by you being called in the room. Sometimes nobody even knows who you are. So it starts by you writing and just sharing your perspectives and opinion and insights publicly. But if you write from the perspective of a collaborator, not an adversary, then someone who doesn't know you sees what you've written and says, hey, this sounds like someone who's saying something, you know, important and beneficial to everybody, and you get called into the room. Because at the end of the day, you can't really agitate from outside. You know, you've got to be in that room, you've got to be part of the conversation to agitate and advance whatever agenda that you're driving to support your business or the ecosystem. Thanks.
Thank you for that. And speaking of agitating from the outside, I think, you know, a lot of fintechs over the last decade have sprung up and are chipping away, agitating from the outside of traditional financial institutions, right? So Dalu, I want to come to you here. And, you know, with your hat as the CEO of Standard Chartered Nigeria Bank, you know, you have, you know, a lot of barbarians at the gate, so to speak, right, in terms of young fintechs. So I just want to get your perspective, and staying with the theme of practical advice, all right? So just what lessons can startups learn from traditional institutions like yours, and what lessons can institutions, legacy institutions, learn from startups as well?
So I think I'll start off with what we can learn from startups. I think the ability to think outside the box, be innovative, and not be bound by, you know, call it past regulation, is an important lesson, because the ability to be creative and the ability to actually think on the edges of innovation is going to be quite critical for us to be able to move the financial industry forward. And quite frankly, I think, you know, structures limit creativity. And we as banks, no matter how big we are, we're bound by the structures that we've inherited over many, many, many years. And trying to create a culture of innovation and culture of creativity within old structures becomes very difficult. And it's not necessarily because you don't have the resources, because you can say we have capital, we have humans, we have an ability to infuse and import talent, etc. But, you know, the culture of innovation is grassroots, it's inbuilt, and it's raw, right? And for you to be able to have that raw ability to be able to get into the sandbox and think creatively is somewhat limited in very large institutions. And I think that's one thing that we can learn from, call it startup, fintech operators, to be able to put out a problem statement and to be able to think outside the bounds as to how to solve that problem without being bound by your so-called legacy structures. And the more we can actually embrace that, and the more we can actually embed that into the culture of a large organization, I think the more nimble, and I wouldn't call it innovative, but nimble we can be in terms of how to tactically solve and strategically solve challenges that we see within our industry. Now, on the flip side, when you think about innovative, fast-growing fintech or fast-growing companies, what you have is as you grow very quickly and think about how to institutionalize your businesses, it becomes an alternative challenge as to how to put structures to allow it to grow sustainably. So it's like saying, we have challenges with structures because we can't think and we can't be innovative. But as you become fast growth, you also need those structures to be able to sustain growth in a very much more sustained fashion, right? And there are very few companies that are able to navigate that conundrum of structures and innovation. There are a few companies, like if you look at Reed Hastings' book on Netflix, the context of how to ingrain a culture of innovation within a very, very large institution is very difficult to do, and it's very difficult to replicate. But I think the benefit that startups have is that because you don't have the legacy structures, you can actually create structures that work for the culture that you're trying to infuse in your organization. And I think that's a very important thing, because you're not going to be able to run away from structures. But now thinking about how to construct structures that give you some of those sustainable elements, but doesn't kill the creative energy that exists within an organization, is going to be very critical. Because I think that energy of innovation is what's going to propel both the financial industry and generally a lot of industries forward. But you're still going to need structures to be able to sustain it. And being able to create something that works for your institution, I think, is a unique challenge that a lot of the startups should embrace.
Oh, that's fantastic. And I think, it's again a practical lesson for folks building in terms of how do I, what structures do I need to create for what I'm trying to achieve. And I think, Yewande, you've seen, with Alitheia being a private equity, you've seen kind of the best of both worlds, right? So you see kind of tech, 100% tech digital companies, you kind of see some real world economy companies and everything in between. So I want to come to you, kind of for, again, a bit of practical advice. Innovation often kind of moves faster than regulation, right? So in terms of the companies you've seen, the portfolio companies and other companies that you've just seen in general, just what are some of the best practices that strike the right balance between innovation and staying kind of compliant with regulations?
Thanks for that. I think, can you guys hear? Okay. I think the very important thing from the get-go, and I think that's been resonating around the room, is this partnership, collaboration, and engagement early on. The quicker you start forming those relationships with your regulator, the better it'll be for you. Because if you're coming up with some wild, wonderful thing they haven't heard of, many years ago when I was in Afina, the position was to slam it and close it down. So if you come to them early on, I'm developing this thing, you've never heard about it before, but it's going to have a lot of impact. And like Akin said, that they want to be the one that actually produced the regulation that made all of it work. So the quicker you engage your regulator to just say, look, I'm thinking about doing this, the better it'll be for you. I really see that, especially when there's the regulator will not understand because it's new, right? Another thing I find is that even working with other stakeholders like your investors, even your consumers, that engagement also needs to happen very early on. Sometimes founders think that, let me just do this thing in secret and then voila. You need to carry on because there's a lot of layers in investing. right? You've got your direct Alitheia, but Alitheia also has people that invested in them, and therefore those theories of change and whatnot need to align. So the more you communicate, I think that's one thing that founders need to do, that communication with their stakeholders, at all levels, at all times, is important as you grow your business. And also this whole test and learn approach to product development and growing your business. I think that is really key, because then you won't deploy excess resources to something that may not take off. I mean, in your world, everything's wonderful. From when your other stakeholders are looking in, they don't love it as much as you do. So they're giving you practical advice in terms of, what's the response to this? Go and check with your consumers, do they want it? And more importantly, is this going to be a problem down the line? When you look at scale, so when you're small, the regulator looks at you a little bit light. But when you come to like our level of growth equity and private equity, you become someone that can actually cause systemic problems if it isn't done properly. So that's why the earlier engagement to understand what's the landscape, what's even a light touch that could remotely touch your business, understand those regulations and be aware of how you're going to comply with it. But more importantly, early, continuous engagement with that regulatory stakeholder to make sure that there's no surprise and they slam you down like the earlier panel that we listened to, because that's it. When they don't understand, the easiest thing to do is to just shut it down, which is bad for us investors, bad for you as a business, bad for your customers, then it causes distrust and it's all a big issue. So the earlier you engage, it's really important.
Thank you for that. So I think I just want to open it up. I think we're at the end of the session. If there's one or two questions, just want to open up the floor to the audience. And
do we have any questions from the audience? There's room for 2 questions, so please, if you have your question, you can raise your hand and they'll bring the mic to you. Okay, there's someone, a gentleman there. Okay.
Okay, good afternoon. Thank you for the insightful session. So I wanted to ask to Mr. Obi 2 questions, actually. As a startup, when building your team, who did you or what do you advise a young entrepreneur to do in terms of delegating the task of regulation and compliance so that we don't go to jail? Yeah. So second question is, can you give us some practical examples of major pitfalls that startups fall into in terms of non-compliance? Thank you.
Okay, great. For the first question, typically, and the thing is, complying regulation is a cost, right? And so you would typically have a chief compliance officer, right, or a compliance department. And the role is they are responsible for discovery or sort of finding out new regulations, making sure they're aware of new regulations or changes, analyzing the regulations to understand the implication, detecting where maybe there's violations and remediating them, right, as well as reporting, So this is like a typical cycle. They would also engage with regulators because there are some cases where you may not be able to comply temporarily because of major constraints. And like I said, even in those cases, you want to remain transparent, engaged. The regulator wants to have a view and be comfortable, even though it's not ideal that you're not compliant. If there's a temporary period, they want to feel comfortable that things are heading in the right direction. So that's the role. The chief compliance officer would also typically report to the board to ensure that the different areas of compliance are being approached properly. So that's the typical structure. It's not very easy to do when you're very early as a startup, but you would imagine that if you're a regulated entity, there might be some baselines, minimum baselines. You just have to achieve, minimum capital requirements and operations you have to be able to even keep the license. So that's on the one hand. So the other question is about, you talked about hiring, right? What was the second question? Pitfalls, yes, the pitfalls. So I think the biggest pitfall typically would be not even being aware of regulations, right? Especially either the implication of regulations that you're aware of, or if you don't have a structured compliance department, realizing when regulations change or when there are new regulations. And I've seen this, right, where something has been published and somebody says to a regulator in a meeting that, like, I wasn't aware, I didn't know this was the case, and so on. And the regulators hate to hear that, right? Because it's not like this thing has been published, it's put out there. You can't say that you weren't aware. And so I think because of lack of focus in that area, just even the awareness that this is a regulation, this is what you should do, or that the way it was has changed, right? That to me probably be the biggest. And so to remediate that, I think just the focus of even having a full scope of what are the constraints I have, what am I expected to comply with, what are the rules, what are the recommendations, guidelines, and all that, and making sure that it's always up to date, right? Like you always have the up-to-date version of this is the starting point on top of which you can now build other things, operations, and all the rest of stuff you need to do. Yeah.
Fantastic. Please join me in giving a round of applause to the panel here. Thank you, Dalu, Obi, Yewande, Akin.